There is an old, ungracious joke that markets like to play on the people who trust them most. The day the world catches fire is precisely the day the fire insurance turns out to be down 13%. If you own gold right now, you have felt that joke personally. You did what 4 decades of financial wisdom told you to do. You bought the safe haven. And the safe haven, at the exact moment safety mattered most, went red. Stay with me for the next few minutes because I intend to explain why, not with a hunch, not with a headline, but with a mechanism so consistent it has repeated, without a single exception, after every major oil shock since Richard Nixon closed the gold window in 1971. Once you see it, you will not be able to unsee it. And once you understand what has, without fail, come next, you will understand why the word I keep reaching for is not correction. It is unthinkable. Start with the paradox, because until it is dissolved, nothing else will make sense. Gold is supposed to be the financial bomb shelter, the thing civilizations have reached for since Croesus minted the first gold coin in Lydia 26 centuries ago, precisely because it answers to no government and depends on no one's promise. So when Iran shut the Strait of Hormuz and the Middle East went up in flame, why did gold fall? The answer is not sentiment. It is arithmetic, and it runs in a straight line. An oil shock, Brent crude vaulting from the mid-70s into triple digits in a matter of weeks, one of the sharpest energy dislocations in half a century, does not merely raise the price of a barrel. It raises the market's expectation of inflation, and expectation is a currency all its own. Traders do not wait for inflation to arrive before pricing it in. That expectation, in turn, strips the Federal Reserve of the one thing it wanted most: room to cut rates. The futures market currently prices in almost no chance of a cut before late in the year, and when the central bank cannot ease, the 10-year Treasury, a bond backed by the full faith of the United States government, paying north of 4% with no credit risk, no volatility, no vault fees, becomes a very loud competitor for gold's affections. Gold, remember, pays nothing. It only sits there being gold. Institutional money does not sit and admire that. It does the math and rotates. That is only half the mechanism. The other half is the dollar. When the world grows frightened, capital does not merely flee into treasuries, it flees into dollars to buy them, and that flight lifts the dollar index. A stronger dollar is, by definition and by arithmetic, a weaker gold price, because gold is quoted in dollars, and it takes fewer strong dollars to buy the same ounce. So you have 3 headwinds: a rate cut door slammed shut, a bond market suddenly more attractive, and a dollar catching a bid. All 3 summoned into existence by the same crisis that, by every intuitive account, should have sent gold soaring. This is not gold failing. This is gold being run over by its own insurance policy. It has happened this way, mechanically, after 1973, after 1979, after 1990, after 2001, after 2022. It is happening again now. And if you do not understand that this is a mechanism and not a verdict, you are liable to make, at precisely the wrong hour, the single most expensive decision of the next 5 years. Here is where the record becomes, I think, genuinely instructive, not as prophecy, because I have buried enough analysts who mistook the past for a promise, but as pattern, and the pattern is too disciplined to wave away. In 1973, OPEC placed its embargo, oil quadrupled, and gold, after its own dip, rose 150% over the following 2 years. Widen the lens across the full arc of that decade, from Nixon's default on Bretton Woods through 1980, and gold's advance was not a rally. It was a revaluation, on the order of 2,300%. In 1979, the Shah fell, Iranian oil production collapsed, and gold, quiet for a season, as it always is, rose 89% in the following year and kept climbing after that. In 1990, Iraq took Kuwait, oil spiked, and gold registered its move within weeks rather than months. After September 11th, gold began a 10-year march from roughly $250 an ounce to $1,000, a climb of some 660%, while the world was still arguing about whether gold worked as a hedge at all. And when Russia crossed into Ukraine in 2022, gold broke $2,000 for the first time in its long life. 5 shocks, 5 suppressions, 5 reversals. That is not coincidence rendered 5 times over. That is a mechanism completing itself, on schedule, every time. What I want you to sit with is this. The mechanism that pins gold down is not a flaw in the metal. It is a temporary borrowing against a future it always, eventually, repays, with interest. The suppression is the loan. The recovery is the repayment. And every structural condition surrounding this particular loan, the debt behind it, the central bank circling it, the industrial hunger for its sister metal, silver, is larger, tighter, and more unforgiving than in any of the 5 episodes I have just walked you through. We are going to spend the next stretch of this conversation on exactly why that is so, and why the gap between where gold sits today and where the most sophisticated forecasting desks on the planet say it is going by year's end is not noise. It is the setup. Stay with me. Let us now do what 1973 could not. Compare it honestly to where we actually stand. In 1973, the United States carried a national debt of roughly $500 billion, a large number for its era and a manageable one. Today that figure has crossed $39 trillion, and the interest alone on that pile runs past $1.3 trillion a year, paid out whether the economy is strong or weak, whether the Fed wants to raise rates or not. This is the detail the cable news arithmetic never quite gets to. In 1973, Paul Volcker's successors had room to take the federal funds rate to 20% to strangle inflation, and brutal as that cure was, it worked. Today, a fraction of that rate would make the debt itself unpayable. The Federal Reserve is not merely reluctant to raise rates into this shock. It is structurally forbidden from repeating the one maneuver that ended the last great inflation. That is not a smaller version of 1973. That is a different country, wearing the same flag. Layer onto that the central banks of the world, who in 1973 were net sellers of gold, disposing of it as a relic of a bygone monetary order. Today they are the most disciplined buyers gold has ever had, north of 1,000 tons purchased annually for 3 straight years running, with more than 700 tons expected again this year, a pace of accumulation that has no precedent in the modern history of the metal. These are not speculators chasing a chart. These are sovereign institutions repositioning their reserves away from paper promises, quietly, for reasons that have nothing to do with this week's headlines and everything to do with what they expect the next decade to look like. And then there is silver, which in 1973 carried no structural deficit worth mentioning. Today, industrial demand has now outrun mine supply for a 5th consecutive year running, a deficit that persists precisely because silver is mostly a byproduct of copper, lead, and zinc mining, meaning producers cannot simply decide to dig up more of it when the price rises. Every solar panel, every electric vehicle at 60 to 80 grams a unit, every AI data center, every piece of defense electronics wants silver, and has, at any reasonable cost, no substitute for it. China, which refines some 60% of the world's silver, has begun restricting exports of it as a strategic material. You cannot manufacture your way out of that shortage. You can only ration it, or bid for it. I want to pause here because if what I have just described sounds true to you, if the shape of it is starting to feel less like commentary and more like a pattern you cannot afford to be caught outside of, then this is the moment to make sure you do not miss where this goes next, because we are about to walk through exactly which phase of that pattern we are living in right now, today, and what history says happens to the people who look away too soon. Subscribe before you go any further, not because I need the number, but because the difference between the investor who understood Phase 2 and the investor who panicked during it has historically been the difference of a fortune, and I would rather you not learn that the hard way, from the outside, after the fact. Stay with me. This is where it gets serious. Every one of the 5 great oil shocks I described earlier moved through the same 4 seasons, and knowing which season you are standing in changes everything about what you do next. The first is the panic phase, the opening weeks, when oil spikes, gold spikes, and then falls hard under the mechanism we discussed, and the television runs red graphics designed to maximize your pulse rather than your understanding. Retail investors in this phase do one of 2 foolish things. They sell at the bottom of the drop, or they buy at the top of the spike. Institutions, meanwhile, do neither. They watch. They have seen this play before, and they know their lines. The second season is the absorption phase, months 2 and 3, when the initial fear subsides, gold drifts lower still, silver falls harder, 15 to 20% or more, and this is the single most expensive juncture in the entire cycle, because this is where the largest number of ordinary investors, staring at a red portfolio and a headline calling gold broken, sell. In 40 years of watching this happen, I have never once seen that sale rewarded. I have only seen it regretted, from a distance, months later, at a much higher price. The third season is the one that matters most to you right now, because I believe, based on the timeline of this war and the price action in front of us, that we are standing somewhere in the crossing between the second season and the third, the structural bid. This is the stretch, typically running from month 4 through month 18, when the forced selling has exhausted itself, when central banks keep buying without regard to the daily headline, when the institutions who spent the panic phase watching begin, patiently, to accumulate, and when the retail investors who sold in Season 2 are left waiting on the sidelines for a pullback that historically does not arrive in time to let them back in at a good price. Miners lever up, energy names catch a bid, and the fourth season, new highs, sustained sometimes for a decade, as they were after both 1979 and 2001, begins to take shape on the horizon. I want to give you two things to actually watch, because the war headlines will not tell you when the turn arrives. They never have. The first is the dollar index, presently elevated above 99 on emergency wartime demand. When it falls back under roughly 97, the principal headwind on gold begins to lift. The second is the 10-year Treasury yield, at present above 4%. When it falls back under 3.5%, the opportunity cost that has been pulling capital out of gold and into bonds reverses, because that fall will only happen when the Federal Reserve is finally forced, by the arithmetic of $39 trillion of debt, rather than by any dovish instinct, to cut. Watch the dollar. Watch the yield. Everything else, the daily oil print, the hourly cable chyron, is weather, not climate. And I would be remiss not to mention what the largest research desks in the world are already saying about where this goes. Year-end targets north of $6,000 an ounce from major Wall Street institutions, with one long-range forecast, recently trimmed notably yet still intact, calling for $10,000 by decade's end. These are not enthusiasts. These are the analytical arms of firms that manage more capital than most nations, and they are not issuing those numbers because they think the current suppression is permanent. They are issuing them because their own models say it is not. Silver, I should add, plays this differently than gold, and understanding the difference may matter more than anything else in this conversation. Silver lagged gold at the start of this move, as it nearly always does, because its price carries two engines rather than one, a monetary engine that responds to fear, and an industrial engine that responds to consumption, and the industrial engine has not paused for a single day of this war. In 1979, that combination let silver outrun gold by a factor of 3, rising roughly tenfold while gold rose a still remarkable 270-some%. When the monetary bid returns to silver now, as the historical pattern says it eventually will not be arriving into a quiet market. It will be arriving into 5 straight years of deficit and a wall of industrial demand that has nowhere else to go. So here we are, a mechanism that has never once failed to reverse, a debt load that makes the old cures unusable, a silver market that cannot manufacture its way out of scarcity, and central banks buying at a pace history has never recorded before. There are, in my experience, exactly two kinds of people reading a portfolio like this one right now. One kind sees red and concludes the story is over. The other kind recognizes the season and waits with something closer to patience than fear. I have watched both types across 5 decades of these cycles, and I know, with more confidence than I know almost anything else about markets, which one is still standing at the end of the story. I don't say any of this to tell you what to do with your own money. That decision, wisely, belongs to you and to nobody narrating a video at you. But I would like to know what you think. Tell me in the comments whether you believe we are already in that structural third season, or whether you think the panic still has one more leg to run. I read every one of them, and the disagreements are usually the most interesting part. And remember, this is for education and discussion only, not personal financial advice.